Welcome to Age, Pension, Super and Retirement. I am your host Yvonne, and as always, this podcast is information only and never personal advice. Today, we will be looking at lifetime income streams and annuities. I'm delighted to welcome back the Director of Prosperity Planning Partners, Gayle McKew. Hello, Gayle.
Good morning and thanks for having me.
And thank you. We've got daylight saving, just to timestamp it here. We're in different time zones, so thanks for a bit of an adjustment from you. And if we can get stuck into it, what actually are lifetime income streams?
Generally speaking, they are able to be purchased with cash, not cash, but cash from your savings account, because you can't buy anything with cash anymore as when it comes to investments, or superannuation money. So from our perspective as advisors, we call cash ordinary money. So you can buy it with ordinary money or you can buy it with superannuation money. And it's designed to last your lifetime and pay regular income. Now, you can choose the frequency, whether it be monthly, quarterly, half-yearly or annually. And that's worked out by actuaries as to what should be able to be paid for your lifetime. They're nothing like the old lifetime annuities that used to be around 30 years ago. And they were, if you put the money in today, that and you died tomorrow, then that money was lost to your estate. The modern ones have a value that comes back to the estate, depending upon how old you are.
Great. So I'm just going to be clear on this. So when people talk about lifetime income streams, that's interchangeable with the word annuity?
Well, yes, but it's also, I'm going to throw another little spanner in the works here. You can have a lifetime income stream from an old defined benefit public service, usually public service superannuation scheme, and when the person dies, the income stream dies. So you've got to be very much thinking about the words that are used.
Yes, that's helpful. So people don't get confused. So income streams can refer to those two things, defined benefit income streams, and they die with the person?
Yes.
Right. So if we looked at some of the differences between perhaps different types of annuities, would you mind taking us through what exists in that world?
Sure. You can have an income stream that lasts for life, and it can have some bells and whistles added to it. When I say bells and whistles, some of them are not CPI, so Consumer Price Index linked. They're just a standard amount that comes to you regularly, and that can mean, if it's not CPI linked, that effectively your money loses purchasing power. If it's CPI linked, then your payment increases. Now, there's a new version of an annuity, because traditionally most people have known an annuity to be very safe, very stable, and no surprises. There's a new version of an annuity which actually allows it to be linked to the market. In those instances, your payment is linked annually to what's gone on in your investment. So if your investment has gone down, there's a chance that your payment for the next financial year will come down. If your account balance has gone up, then your payment from that account linked annuity will go up.
That's really helpful. And now my next question's around tax and income streams and annuities, but perhaps I could step back and first ask about the defined benefit pension income streams. Is tax paid on that income usually?
In my experience, we've had defined benefit schemes that have ongoing lifetime income streams attached to them from untaxed funds, which means that effectively when the money comes out in the hands of the annuitant, like the person receiving the annuity, that effectively it will be taxed. And you will usually get a 15% tax offset if the money is coming from super. If it's not coming from super, it's still taxed. You can claim the tax-free threshold on that, But in most instances, if people are in receipt of an age pension and they're getting more from the age pension than they are from a defined benefit payment, then they tend to claim the tax-free threshold on the age pension rather than the defined benefit. But if it's the other way around and the defined benefit is providing the greater income, then in a lot of instances people will claim the tax-free threshold on that.
Oh, before we move on to annuities, I must ask, you mentioned about an offset. So were you suggesting that the income stream from the defined benefit pension can be taxed at a normal income tax rate?
It is.
Right, okay.
Yeah, there's no such thing really as a pensioner tax rate, as much as we'd all like to see that potentially happen. What is available is offsets and low-income tax offsets and senior Australian pension and pensioner tax offsets. So there's different offsets, but this one specifically relates to money coming from an untaxed source of superannuation.
Thanks so much for clearing that up. Now, the tax on annuities, is tax paid on the income of annuities?
Well, it's still an investment. So unless it's a superannuation-based payment, then there will definitely be taxable income coming from that annuity.
Could you say more about that, unless it's a superannuation payment?
So if it's coming from super money, it's already superannuation is a tax-free environment. So if you use part of your superannuation to create a income stream, as in an annuity, then it can be tax-free in the hands of the recipient.
I've just had a penny drop moment. So
Did I? I heard a little bit of something going on there. Yeah,
you could hear it clunking. So it's what money was used, where they originated from, as in from inside of the superannuation or not.
Correct.
That is so interesting.
It's really interesting because most people just presume that it relates to the product that they've purchased. It doesn't necessarily. It actually relates more to the source of funds.
Yeah, that's really interesting. Now, I've heard of market-linked and CPI-linked annuities. Are these how do these terms differ?
Okay, CPI, it's Consumer Price Index. So you know how let's stop and think of what $100 buys you now at the grocery store. And you and I both know you'd be flat out to come out with a decent sized bag. Whereas many years ago, you could actually get half a trolley for $50. So you get a trolley full of groceries for $100. So that loss of purchasing power is really the impact of CPI. It's actually a loss of, well, hang on, let's go back. It's inflation. And inflation reflects the consumer price index changes. You know how you've at times had to pay $12 a kilo for bananas, and they're usually $4?
Yes.
That's because there's been a weather event and there's not been fruit available. But in normal courses of events, somebody who wants it's still going to go and buy it regardless. So this does impact CPI. But a market-linked one is very much like it's invested in line with whatever risk profile the investor has. It's similar to an account-based pension in that what you put in is what you get out. And market-linked annuities are a relatively new breed of annuity.
Right. So I'm just going to check my understanding. If an annuity is linked to the CPI, is that sort of indexed once or twice a year, whereas the market-linked is just fluid?
Well, no, they're still set at the same, like for a year. But if it's CPI and CPI goes up by 5%, and your payment should go up by 5%. But if by some chance the market-linked version, the overall balance goes up by 20%, you don't automatically get a 20% increase in your payment, but they calculate it based on the value of what's there. So if it goes down, it goes down. But if it goes up, you take advantage of that. It's nothing really that different than a current account-based pension where people go, oh, the share market went down, but they never really celebrate when it goes up.
So true.
So it's one of those sort of situations.
That's really helpful. Now, I've heard the phrase of locking in interest rates. Are they locked in with annuities?
Yes, they are. So if you choose, and that was another thing I wanted to talk to you about, is annuities can be anywhere from 1 year through to lifetime. So you can you can choose whether you have a residual capital value on the short-term ones, not the lifetime ones, but the short-term ones, or you can choose to have a zero residual capital value. You can have 60%, or you can have 100% residual capital value. And when I say residual capital value, if you've put 100,000 in and you have a zero residual capital value, you will have zero left at the end of the term. So effectively, you're using your capital in an organised way. They do not have, the short-term ones do not have concessional testing from Centrelink. The lifetime ones do.
So interesting. And are some annuities deferred, as in they're not started straight away?
That used to be a very, very popular thing. There's one company that I'm aware of who's looking at basically restarting them, but a lot of people are not interested in maybe being 60 and putting money into a deferred annuity that they won't access till they're 67. Most people are a little bit nervous about giving up access to their capital. We see that in some of the comments in the Facebook group where people are going, I've been told to put this much money into annuities, and I fully understand why it's happening. And in a lot of instances, it's because the client has said, I want you to get me access to a Centrelink entitlement. And if we use a lifetime annuity, then Centrelink will look at it and go, hey, we're going to give you a bit of a relief. We're going to only assess 60% of the capital value that goes into an annuity and 60% of the income versus what you actually receive.
Yes, we might unpack that in complete detail, that interaction with annuities and Centrelink shortly. I'm curious. Sure. I'm curious, Gayle, what does guarantee of capital mean with annuities?
So most of the providers that operate in the annuity space have to operate under APRA rules. So APRA, which is Australian Prudential Regulatory Authority, their rules are much stronger guarantees than if you were going to the bank and saying, hey, here's my couple of $100,000, put it in a term deposit. You know that the banks currently have a guarantee that allows them to, if anything goes wrong, it's a government, well, it's not really a government guarantee, but it's a guarantee that you'll get your capital back. Whereas with an APRA guarantee, it's actually stronger than that because they actually have to have actuaries work out where and how much to invest to make sure that everyone is going to get their return of capital.
That's really helpful, Gayle. And the older style annuities, how do they actually compare with our current annuities?
Well, I've been planning long enough that I have seen annuities that have gone into play and they have been 100% asset test exempt. Then Centrelink went, oh, hang on, we're being a bit generous here. So then they went, we'll go 50% asset test exempt. And then they stopped that because there was a significant flow of money there and it made a difference to the way Centrelink paid people. The newer ones are not 50 or 100% asset test exempt. They're in place and they will give you a, shall we say, a concession of only assessing 60% of the asset value that is invested in the annuity. Now, I'm going to use $100,000 as an example. We've put it into a lifetime annuity. The asset value that will be assessed for Centrelink purposes is $60,000, not $100,000, which automatically gives an uplift to the pension under the asset testing regime. The income side of it depending upon the age of the person. So there are some factors that we look at that are very different when it comes to annuities and lifetime setups, because they use what's effectively known as a life expectancy to work out factor, which is available from previous census and life expectancy tables. So effectively what happens in that instance is part of it is considered to be a return of capital, and then only a certain amount is then assessed as income. And Centrelink will work around those numbers depending upon the age of the person and the type of annuity that's gone in place. So many dependings when it comes to annuities.
That's so interesting, Gail. And I've also heard the phrase residual amounts with annuities. What's that about?
So remember I mentioned earlier residual capital value. So it's frequently referred to as an RCV. And that basically is how much of what you put into it will be left. So it's usually a shorter term annuity where you can decide whether you want to use 100% of your capital, none of your capital, or a portion, like 50% of your capital. And that if we put $100,000 in, we have a 50% RCV. At the end of the annuity term, there will be $50,000. If it's 100% RCV, $100,000 will be available if 100 went in. And these are, as I said, short-term annuities. Lifetime annuities tend to have a different calculation method. Again, part of it is to do with, because they have a guaranteed period where you can access capital if you want to, you can get values back to your estate, but part of that depends on your age and part of it depends on how much was invested. So it's not something that's really simple to say, hey, this is the hard and fast rules, because the hard and fast rules are basically that it's going to be calculated on your age, your amount that went in, and your likely life expectancy.
That's so helpful, Gail. If someone wanted to reach you, how can you be reached?
You can email me on Gayle, Gayle, at prosperityplanning.com.au, or you can call me on 0407 159 298.
Wonderful. Now, just to finish up, Gail, you've touched on the interaction between annuities and Centrelink. So is it a case of they're now incentivising people to have an annuity so that they might, where they may not qualify for any age pension, or they might, if they use an annuity, qualify for more age pension? Is that sort of a calculation that say financial planners do?
We do take that into consideration. We also take into consideration something like the health of a person. So I know you'll laugh, there's annuities that are in place that have got a reversionary beneficiary, and that's somebody who's pre-nominated, and they then get a portion of the amount that will continue for the rest of their life. So that's like I mentioned to you before about the old defined benefit income streams from defined benefit super funds. Most of those, if you're a member of a couple, have the capacity for the partner to get roughly 60% of their income stream, partner's income stream, when they die. But there's no capital value behind it. And then you'll have a guaranteed period in the more modern ones, which allows a minimum payment period where your beneficiary will get your payments either as a lump sum or as an income stream if you die before your ideal life expectancy. There's a whole range of different little tweaks that are available on current annuities that were not available 25, 30 years ago.
That is so helpful. And do people get these from their regular superannuation funds, or are they outside?
Some funds are providing them. Most of them are providing like an older style version that's very stable. Not very many are providing market linked. In fact, I only know of one provider that provides market linked annuities. But having said that, it's a relatively new field to have a market-linked annuity. So I'm sure there will be more providers come into play over time.
This has been so helpful. Thank you so much, Gayle.
You're welcome.
For our international listeners that are wishing to join our Facebook group, the code word is orange, and as always, this has been information only and not personal advice. I look forward to speaking to you again soon, Gayle.
Thank you very much.